Okay, let's go ahead and go through the solution to the sort of overall example, which includes a merger with contingent consideration, where we're going to go ahead and incorporate the present value of the consideration, as well as changes in the expected value, as well as goodwill impairments. We're going to do a bunch of things all at once here. So assume that on January 1st, 2020, Big acquires Little in a transaction to be accounted for as a merger, and Little Company has the following trial balance at the date of acquisition. Both book values and fair values are given. Assume that Big paid $650,000 in cash plus a contingent payment agreement. If sales growth for the combined entity exceeds 10% annually for 3 years, they're going to pay an extra $50,000. And on the date of acquisition, Big estimates there's a 40% chance that that will happen. Any contingent liability is going to be discounted at 10% to determine its present value. At the end of the first year, we have information on the book value and fair value of the Little business unit, so we can do our goodwill impairment test. And the estimated likelihood of paying the contingent liability has risen to 50%. So apparently where things are looking better than we originally anticipated, we're a little more sure that we're going to make that payment, so the probability rises from 40% to 50%. Similarly, at the end of 2021, we have information on the book and fair values of the Little business unit, and the estimated likelihood of paying the contingent liability rises to 70%. And then finally, at the end of 2022, we have information on the book and fair value of Little again, and actual sales growth comes in at 11%, so we make that final payment. Okay, so what do we need to do? First, let's go ahead and figure out whether there's going to be goodwill or a bargain purchase on this. And again, I can't stress enough, the book value of all of these various assets is completely and utterly irrelevant. What we're concerned with are the fair values. So what are we getting? We have the fair value of the net assets. So the total assets, cash through the patents, so 20 plus 29 plus 30 plus 470 plus 80 is $629,000 in assets, minus $122,000 in liabilities, gives us a fair value of net assets of $507,000. The amount we pay, again, we're making two payments. There's going to be a cash payment of $650,000, and there's also going to be the contingent liability again, $50,000 future payment. We think there's a 40% chance of that happening. So 40% of $50,000 is $20,000. And we want the present value of that. So we're going to discount that for 3 years, the time until that payment is made, at 10%. So $20,000 discounted at 10% for 3 years is $15,000, let's just round it off to say $15,026. And so the total payment, $665,026. So we paid $665,026 for net assets with a fair value of $507,000. And so there's a substantial amount of goodwill built into this. Again, the difference between the fair value of what we acquired versus the price we paid. So that's a difference of, what's that, $158,026. Okay, so let's go ahead and record this acquisition. And again, what we're going to do is we're going to basically record the acquisition of all of these assets and the assumption of these liabilities at their fair values. And the only two sort of wrinkles thrown in here are, first, the receivables. The receivables have a book value or a face value of $30,000. Perhaps I shouldn't have crossed all these out. I'll go ahead and uncross the relevant ones. The receivables have a face value of $30,000. They're only worth $29,000. And why would that be? Well, because we're not going to get all of the money paid to us. We know that if we have receivables, a certain portion are going to be uncollectible. That difference is going to be our allowance for bad debts. We don't directly reduce the receivables because we don't know who's not going to pay us, and so we don't want to eliminate any specific receivables. Instead, we're going to create the allowance for bad debts. Similarly with the bonds payable. The bonds payable have a $100,000 face value. They're worth $102,000, so we're going to have to go ahead and record a premium on bonds payable. So let's go ahead and record this acquisition. I'm going to go ahead and jump over to the right-hand side of the screen. We're going to have cash, $20,000. We're going to have accounts receivable. Face value is $30,000. And I'm going to go ahead and scooch down a few lines and put in the allowance for bad debts. So between the receivables and the allowance for bad debts, we have our $29,000 fair value of the receivables. We'll go ahead and put the inventory on the balance sheet at its fair value. We'll go ahead and record the property, plant, and equipment at fair value. Again, the accumulated depreciation does not get carried forward. When you buy a used asset, you simply record as its cost the price you paid for it, the fair value. You don't assume the previous owner's accumulated depreciation. We'll go ahead and record the patents at their fair value. And we record that big chunk of goodwill, $158,026. On the credit side, we're going to assume the accounts payable of $20,000. We're going to assume the bond payable liability, and of course bonds payable always goes in at face value. The extra $2,000 of fair value on the bonds payable is going to be a premium on bonds. Okay, let me go ahead and get my allowance for bad debts up there. Okay, now we go ahead and record the payment. We're going to write a check for $650,000. And we're going to go ahead and record this contingent liability, which we determined was $15,026. Again, the present value of the expected value of the payment. So again, the expected value, 20% of 50,000 is 20,000. Present value of that discounted for 3 years at 10%, 15,026. We come around to the end of the year and we need to do two things. One, we need to accrue interest. We need to do three things, I'm sorry. We accrue interest on that contingent liability. Again, that present value of $15,026, that was the present value discounted at 10%. We're going to accrue 10% interest on that, and so we're going to have interest expense of $1,503, again just rounding off to the nearest dollar, and that gets added to our contingent liability. The next thing we need to do is revise the contingent liability so that its balance reflects the present value of what we expect to pay. And again, at the end of 2020, let me go ahead and move this up there where it belongs, the additional information. At the end of 2020, the estimated likelihood of paying the contingent liability has risen to 50%. That means that the expected value of that contingency, 50% of $50,000 is $25,000. That's going to be paid in 2 years, so the present value at 10% for 2 years, $25,000 divided by 1.1 squared, or 20,661. Now, if you were to look at the contingent liability account, we started with a balance of 15,026. We added 1503, so 15,026 plus 1503 gives us a balance of 16,529. That's the existing balance. We need again, that's simply adding up the original balance of 15,026 plus the interest we accrued. The desired liability is 20,661, the present value of the revised expected payment. And so basically we need to increase the liability by about $5,000. So 20,661 minus 16,529, we need to boost that by 4,132. So we'll go ahead and basically undo the credit side first. We're going to go ahead and increase the contingent liability. On the debit side, we're going to treat that, sort of questionable as it may seem, we're going to treat that as a loss. Okay, the last thing we need to do is our goodwill impairment test. Again, at the end of 2020, the book value of the little business unit, so that's basically all of their assets minus all of their liabilities, is $700,000. The estimated fair value of the business unit is $720,000, so there's no impairment. We're done. Okay, let's go ahead and then go on to 2021. We're going to have to do the exact same thing. I just sort of get all of our ducks in a row. The existing contingent liability, again, last year we forced it by this adjustment here. We forced that contingent liability to have a balance of $20,661. And again, we need to do three things. We need to accrue interest on that contingent liability. We need to adjust it up or down to its new correct value based on it being the present value of the expected payment. And finally, we need to do our goodwill impairment test again. So first, let's go ahead and accrue the interest. Interest expense, we're using a 10% discount rate so 2,066, 10% of the contingent liability balance, and that gets added to our contingent liability. Now, our existing liability balance then, again, it was at the beginning of 2021, $20,661. We increased that by 2,066, and so it's up to 22,727. Now we say, what should that balance be? That balance should be the present value of the expected payment. And again, the estimated likelihood of making that payment has risen to 70%. So 70% of 50,000, the expected payment is $35,000. But again, there's still 1 year to go before that payment is made. So we're going to take the present value of that expected value for 1 year at 10%, so $35,000 discounted for 1 year at 10% is $31,818. So basically, we need to increase the liability balance from $22,727 up to $31,818, an increase of about $9,000. So $31,818 minus $22,727. We've got to increase that by $9,091. So again, that's going to be a loss. And that gets added to our contingent liability. Okay, so now our contingent liability has that desired target balance of $31,818. Then lastly, we have to do our goodwill impairment test. And again, the first thing we do is we look at the book value of the business unit and compare that to the fair value. In this case, we've got a problem. The book value of the business unit is $800,000. The fair value is only $790,000. So basically, we need to impair our goodwill. We want to impair the goodwill so that we reduce the book value, we reduce the asset goodwill. We're going to reduce the book value from $800,000 down to the fair value of $790,000. So we want to take a $10,000 impairment loss. Now, if we don't have $10,000 in goodwill, then obviously we can't impair the goodwill for $10,000. But if you recall, when we first had this acquisition, way back at the beginning, we had this huge $158,000 goodwill balance. So there's plenty of room for impairment there. So we're going to go ahead and record an impairment loss of $10,000. Let me get my accounts lined up there. And we're going to go ahead and reduce our goodwill. Okay, so we've written the goodwill down by $10,000. That reduces the book value of the business unit by 10,000 down to 790, which equals the fair value of the business unit. Okay, 2022, last time, same, well, not exactly the same three things. The first part's the same. We still have to accrue interest. The present value of that, our current liability is $31,818. We have to accrue interest on that. So interest expense, $3,182. And we add that to our contingent liability. This brings our liability balance up to $35,000. Again, that was the expected value that we computed last year. And again, basically last year we took the present value of that for 1 year. Now we've accrued interest on it, which brought it up to $35,000. Now it's time to satisfy that liability. And again, in this case, we had a simple yes or no payment. Either we were going to give them $50,000 or we weren't going to give them $50,000. They met the earnings target, so we're going to write a check for $50,000 to pay off that contingent liability. So we're going to go ahead and pay off the liability. So debit the contingent liability. We're going to write a check for $50,000. That extra $15,000 is going to be yet another loss on that contingent liability. Okay, finally we have our goodwill impairment test again, and again the goodwill impairment test is done periodically. Book value of the business unit is $850, fair value $770. So oh geez, we've got a huge impairment loss we need to take here. What we'd like to do is write the business unit from $850 all the way down to $770. So we need an $80,000 reduction. So the question then again is, can we take an $80,000 impairment? Again, we want to get the accounting value, the book value, the carrying value. We want to reduce that from the existing balance of $850 down to the fair value of $770, a reduction of $80,000. And I'm typing a little too fast. My fingers can't keep up with my brain. Okay, so can we take an $80,000 impairment? Again, back at the beginning of this whole process, we recorded goodwill of $158,026. Last year, we already impaired $10,000. So the current goodwill, or the remaining goodwill, is still $148,000. So we've got plenty of room to take an $80,000 impairment loss. So we'll go ahead and record an $80,000 impairment loss. And again, we're going to go ahead and credit or reduce that goodwill that we created a number of years ago.